6 months ago, I invested almost £10,000 into a single fund in my Trading 212 Stocks and Shares ISA. In today's video, I want to take you through exactly what happened. I'll show you what I invested in, how it performed, the ups and downs, and the lessons that you can take away from this. This video is not a flex. I'll explain exactly why I had £10,000 to invest all at once. And it's also not a prediction video. I have no idea what the markets will do in the future. It's just a real example of what investing £10,000 6 months ago has resulted in. So let's start off with that context. Why did I have £10,000 to invest all at once? Well, it's because back in June, I transferred one of my other stocks and shares ISAs into my Trading 212 stocks and shares ISA, just so I had all my stocks and shares ISAs in one place, just so I can look at Trading 212 as my main ISA. And as part of that process, I unfortunately could not do an in-specie transfer where you can transfer the investments directly. I had to liquidate the investments on my previous platform and then move the cash over to Trading 212. So I had about £23,000 in investments sold on the other platform, and then that cash was moved to Trading 212. Now, the reason why I'm only talking about £10,000 invested in this video is that for whatever reason, I can't remember why, maybe life got in the way, maybe I was overthinking, I only invested £10,000 on the first day, and then I invested the remainder on the second day. So we're just going to focus on that £10,000 I invested into one fund on that first day of the transfer landing. So what did I actually invest in? What fund did I pick? Now, before we go into this, I want to make very clear this is not investment advice. I'm not a financial advisor. I'm just showing what I did with my own money. When investing, your capital is at risk and past performance doesn't guarantee future results. Please do your own research. With that being said, I picked the SPDR MSCI All Country World Index Tracking ETF. So let's break down the name of this ETF. SPDR is the fund provider, the ETF provider. MSCI All Country World Index is the index this ETF aims to track, and this is a global index that tracks stocks in both developed and emerging markets. It contains about 2,300 stocks, and I picked the global fund because it's simple, low cost, diversified, just delivers a return in the global stock market. There's more exciting strategies, there's riskier strategies, there's less risky strategies. This is what I did and what works for me. I'm not trying to beat the market, just giving the return in the global stock market. And the reason why I went for this global fund in particular is it has a pretty cheap fee of 0.12%, a total expense ratio of 0.12%. There are other global funds out there. Some are more expensive. There's one that's actually cheaper. I went with this one. It's accumulating, dividends automatically reinvested, relatively low fee, and it did the job for me. As I mentioned, a global fund contains thousands of stocks, but this fund is market cap weighted. What this means is that not every company has the same weighting. The greater the value of a company, the greater the market value, the greater the weighting it has in the index and therefore the fund. So you can see the top 10 holdings of the ETF that I invested into here. It's dominated by stocks like Nvidia, Apple, Microsoft, Google, Meta, Amazon. You'll have them on screen to see. So although it contains about 2,300 stocks, the top 10, I think off the top of my head, make about 23, 24, 25%. So this is just a consequence of just how dominant some companies in the world are. The beauty of a global index tracking fund is it rebalances automatically. As companies become smaller or larger, they have a greater proportion or a less proportion in the global fund. So I've got the details of the exact purchase here. I purchased the shares on the 4th of June. I bought 53 shares at a share price of £185.11. The total value of the holding was £9,810.83. So as I said, almost £10,000, but it works better in a title to say I invested £10,000. Sorry if you think that's clickbait. And before we jump into how this investment performs month to month, I want to quickly thank Trading 212 for sponsoring today's video. I use Trading 212 for my main stocks and shares ISA. They're super competitive when it comes to fees, zero account fees, 0.15% foreign exchange fee, and no commission on trades. They offer thousands of stocks and ETFs to invest into, so you are sport for choice when deciding on your investments, and their app is frequently updated and packed full of features. If you do want to try out Trading 212 as a viewer of my channel, you can get a free fractional share worth up to £100 by using my link in the description, or you can scan the QR code on screen if you're watching on TV. Alternatively, within 10 days of opening your account, you can go to the menu page, use promo code, type in Tom, and you'll be able to claim your free fractional shares. For full transparency, that is an affiliate link and code, so if you do use them, I do earn a small commission at no extra cost to you. Thank you to Trading 212 for sponsoring today's video. So, firstly, let's start with June to July, the first month. By the 4th of July, so 1 month on, the share price had risen to £190.99. That meant the total value of my holding was £10,122.47. So we had a really good start in the first month, a return of 3.18%. The context here was inflation data in both the US and Europe came in better than expected. Markets love lower inflation data as it means that interest rates are more likely to fall. Lower inflation means that central banks feel more at ease and more able to lower interest rates. And just to put things into a bit of wider context, in April this year, we had the Trump tariff announcement that did send markets in free fall, but that free fall didn't really last very long. And there was about a 20% dip in the S&P 500, and it did start recovering almost straight away. It was only down for a few weeks at most. And by the time I made this investment in June, it was already well on its way to recovery. And June to July, as you can see on screen here, was more of that recovery. Next up, with the second month, July to August. So by the 4th of August, the share price had risen to £197.40. The value of my holding was £10,462.20, or a return of 6.23%. So this is an incredible start to an investment. Investing is not always like this. We'll get onto that at the end of the video, but 6.2% in 2 months, I certainly couldn't complain. The background to this was we had the earnings season, and a number of companies, big tech giants, did deliver some strong results and prove that the AI hype at the moment wasn't just hype. Onto the third month period, August to September, we had another strong month. The share price had now risen to £200.55. The value of my holding, £10,629.15. The return, plus 8.34%. The main event in this month period was Nvidia's earnings towards the end of August, and again, they delivered. And it just goes to show that although Nvidia looked expensive and it had just shot up month after month for the past 2 years now nearly, it just goes to show you can never predict the top, and it did have another great set of earnings and continued to rise. Then we had September to October, and it was another strong month period. The share price at this point was £209.94. The value of my holding, £11,126.82. Return plus 13.41%. So it just was an incredible time to be invested in this 6-month period. I can't lie. And I really want to encourage you to watch to the end, because I'm not saying investing is always like this. Now we're on to the October to November period. And again, returns were really good. The share price at this point was £217.62. The value of my holding, £11,533. And the return plus 17.56%. So lastly, we had the November to December period. This was the first red month period. We did have a few blips along the way, but this was the first time that I was actually down compared to what was in the previous month. And I'm recording this on the 1st of December. The current share price at the time of recording is £215.29, which means the value of that investment is £11,410.37. Total return plus 16.3%. So to summarize the final results, that initial £9,800 roughly investment ended up being £11,410 plus 16.3%. This was an exceptional result and a fantastic period to be an investor. And I did absolutely nothing fancy. I had one of the simplest types of investment, a global index tracking fund. This was the return of the global stock market. Backdrop of this was that in April we had that Trump tariff dip, and it was already starting to recover between April and June by the time I put this lump sum in, and the recovery just continued until present day. That minor blip over the past month really does nothing to undermine what has happened in the preceding 5 months. Now, I do hope that was interesting to see the journey of a real investment of nearly £10,000 over the past 6 months, but I do want to end on some key lessons and key things to remember and keep in mind. First of all, 6 months is nothing in long-term investing. When I talk about long-term investing, I mean a minimum of 5 years, preferably 10 years plus, and that gives me time and chance to ride out any volatility in the stock market. Of course, over the past 6 months, this means investing looks amazing. It's this incredible returns by doing a whole lot of nothing. So that links us to the second point. This was an unusually strong period. Investing is not always like this, and this unfortunately does lead to recency bias. Investors that started investing 6 months ago have seen nothing but green almost. So this can lead to unrealistic expectations. And you do see on social media like TikTok and Instagram specifically, there's a lot of stock picking gurus and people showing off incredible gains on Magnificent 7 stocks or some other hype stocks, whatever it may be. And that's brilliant. I'm really happy for them. But that does not mean they're the next Warren Buffett and they're going to be able to consistently pick those incredible winners and get these exceptional returns every year. It has been an exceptional period for the stock market. I need to work on my vocabulary. I think I'm saying a lot of the same words here. There's nothing wrong with feeling confident and being happy about your returns. That's brilliant. Just make sure you don't verge into overconfidence territory, start taking on more risk, investing money that you need for the short term, thinking that you're going to be able to find the next big winners or returns are going to be double digits over the next 6 months. They might be, they might not. Just know that it isn't typical and it isn't always like this. The next lesson here is that timing matters far less than consistency and just being invested. And what I mean by that is that by June, it had already started to recover. The global stock market had already started to recover since the April dip, crash, whatever you want to call it. And some people might have seen that and thought, oh, I've already missed the recovery. I better wait because it might dip or crash again because Trump might announce some more tariffs. And if people did that, they would have missed out on these 6 months of great gains. So it's not always the case that if you've seen a recovery, you think, oh, I've missed out. I can't invest now. Well, it just goes to show that in this case, the recovery just continued, and trying to time the market to be smart rarely works. The next lesson is that investing does not need to be complicated. I achieved these results with a simple global index tracking fund. I wasn't picking stocks, I wasn't exiting and re-entering positions. I just sat there and let the global stock market do its thing. Now, this strategy may not be suitable for you. You may have a high risk tolerance, you may have a low risk tolerance. I'm just using this as an example to show that investing does not need to be complicated, and you don't need 3 monitors on screen with different charts trying to work out what's going on. It really doesn't need to be complicated, especially if you have a long-term mindset. And that leads us on to the last point to summarize all of this. Sticking to your plan, being consistent, and thinking long-term matters more than anything else. Yes, I had a great 6-month period for this investment, but I was fully prepared for it to be a terrible 6 months. I invested knowing that I need to put this money away for a minimum of 5 years. Long-term investing into stocks is likely to outperform cash, but there'll be plenty of volatility along the way. Yes, there's no guarantees, but one thing that is guaranteed is that if you hold all your money in cash, it's probably going to not keep up with inflation and the real value of your money will decline. So investing into equities can be a great way to grow your wealth as long as you go into it with the right mindset, don't invest money you need for the short term. And the most important thing here is to not think that investing is only for the already wealthy. That is it for this video. Let me know your thoughts in the comments below. And if you enjoyed it, be sure to leave a like and subscribe for more personal finance and investing content. Thank you for watching.